Most accounting firms find themselves stuck at some point during their growth. This is because as the firm grows, you face new challenges, the numbers get bigger, and it becomes more and more difficult to change the path you're on if you find you're doing something that isn't working. For example, you hire too many administrators, so you're unable to lift firm productivity above 50% and you become stuck. Another common example is you don't have any visibility into your team's capacity. So you overload your best team members, they become stressed, they resign, then you're left holding the baby while you race around trying to meet deadlines. So in today's video, I'm going to break down 5 steps on how to grow your firm that will guarantee you won't get stuck. The 5 steps are to firstly, understand your work in progress, then increase your productivity, improve your recoverability, nail down your pricing, and finally, optimize your capacity. So my name's McTavish and I'm the CEO and co-founder of Link, which is practice management software we've built for modern accounting firms. Now I've been working with firms for over 15 years, and this has given me the opportunity to analyze the data for more than 1,000 firms all over the world. This has given me unique insight into what numbers to track and what really drives performance in a firm. There's no education around the operations of running a firm. It's not taught in college and it's not taught online either. This is an art that's passed down through established firms, but unfortunately, this information isn't being spread far and wide enough. So a lot of people are out there struggling because they don't have this information. This art is what I teach in these videos. Understanding work in progress is foundational to running a firm. To define work in progress, it's work done, not yet invoiced. So we can look at this from a very basic level. It's the value of work done that hasn't yet been invoiced, but there's also a formula that we can look at that looks at the movements of work in progress over a period, and that's what we're going to look at shortly. But let's just focus at the moment on the most simple form of work in progress. So let's say I'm going to do some work for you. I'm going to do a tax return for you, and my billable rate is $100 an hour, and we agree that I'm going to charge you $100 an hour for the service. Now, if I do 5 hours of work, we can say that I've accumulated $500 of work in progress. This is an asset to me, and I can exchange at any point for an invoice with you, which you'll pay for the work that I've done. Work in progress can be expressed as a formula. So at a very basic level, it's work done, not yet invoiced, but we can look at this over a period to understand what our movements are. And that's really relevant when we're looking at lots of jobs and lots of clients. Right, so the formula is opening work in progress, or abbreviated to opening WIP, plus time, plus disbursements added, less invoiced, plus net write-ups equals our closing WIP. Now, disbursements added is anything that isn't time related. So that could be a filing fee, it could be travel, it could be accommodation, anything we accumulate that is a cost that we're going to on-charge to the client that isn't necessarily time. So that's the formula here, and let's add some numbers. All right, so let's say that this is April, right? So we're going to start this job in April. So we'd start with 0 opening work in progress because we've done nothing. We add $400 of time, which is the 4 hours at $100 an hour, which gives us a closing WIP balance of $400. Now, let's say that it's now May, so it's the next month. Now, we're going to have an opening WIP balance of $400 because that's work we did in the previous month. So when we run this report, we can run it for a month or a week or a year or a quarter, whatever it is. But let's say we're running it for May now. We run it for May. We say at the 1st of May, we opened up with $400 of work in progress. And then we would then have $400 of closing work in progress. Now let's say we do another $600 of time, so another 6 hours. So then we'd see $400 of opening WIP, time added is $600, giving us $1,000 of work in progress. So as you see, we've added the WIP from the previous month to the WIP in the current month, giving us $1,000. Now there's only 3 things you can do with work in progress. You can leave it, you can invoice it, or you can write it off. Those are only 3 options. So in this example here, let's say we invoice it. So we've got the opening WIP of 400, we've got the time added in this period of 600, and we've invoiced $1,000, which is represented as a negative because we want to add along this line to arrive at our closing WIP. So we arrive at 0 work in progress. So what we've done here is we've exchanged this work in progress for an invoice, which is later going to become cash in my bank account. Now I have no WIP. Exchange one asset for another. All right, so let's say it's May already. So we know what happened in April. There's $400 of WIP. Now in May, we're going to have $400 of opening work in progress, and then we add $600 of time like we did before. But let's say there was an agreement we had where I said, look, I'm just going to charge you $800 for this job. So I've put $1,000 of time to the job, but I'm only going to bill $800. So then when I send an invoice, that's for $800, so negative $800. So we arrive at a closing WIP balance of $200. Now we don't want to hold on to this $200 because I'm never going to bill it. So that's where we want to write it off. And then what we'd see is opening WIP 400, time added 600, negative 800 for invoiced, and then negative 200 for our write-off, giving us 0 work in progress. So let's look at another example, right? So let's say rather than quoting you $800, I quoted you $1,200. So under this situation, we'd have the $400 of opening work in progress, we have the $600 of time added, we then invoice $1,200, so then we end up with a negative $200 closing WIP balance. So what we want to do there is we want to do a WIP wash up again, where we close the job out. So how this looks is we then have a positive $200 value in our net write-ups, which means we've got a write-up on this job, which means we managed to invoice more than the work we did. This is a positive thing. So if we add along those lines here, we arrive at 0 work in progress again. So we've closed this job out. Now we're going to look at one more situation here, which is going to look at negative WIP. So positive WIP is any time or disbursements we add, where negative WIP is any invoices. So if we've done no work and we just send an invoice for the job of $1,200, we're going to accumulate negative work in progress. And as we do our work, that negative balance drifts down towards 0. Cool, let's look at this. So in April, let's say we opened with no work in progress, no time added, and then no disbursements, and then we sent an invoice for $1,200. We'd recognize this as negative $1,200 of work in progress. So we close out at negative $1,200. In April, we add our $400, which means we then have a negative $800 closing WIP balance as we roll into May. In May, we have negative 800. We do our $600 of time, which closes us out negative $200. And finally, when we do our WIP wash up and close the job out, we'd have a $200 write up, again, positive, giving us $0 as our closing WIP. So what we've just looked at the WIP formula, and this is very, very important, and it's going to become more and more relevant as we start fleshing this out further. But that's a really important formula to understand because it looks at a certain period, because you have opening WIP balances and you have closing WIP balances. We're able to look at where the movements are within that period. And what gets really interesting is we can start analyzing things like write-offs, revenue. We can start bringing some more values in to start building up a story of what's happening in our firm. But it's important to understand that work in progress is work done and not yet billed, but we can also have billings with no work done, which is negative work in progress. If you want to improve the performance of your firm, the first place to look is your productivity, because most firms are punching far below where they could be. So let's define productivity. So productivity is a measure of output against the input. Now there's a formula we use to calculate productivity, which is billable time divided by total time. Now this is something we can measure, and it's very different to how productivity is described in common language. In common language, we say that we're productive if we get a lot done. If we're busy, we're productive. But in a business context, that is not accurate. In a business context, we define productivity by doing the right work versus the not right work, I suppose. So what is the right work? The right work is client work. So if we're working on client work, that's productive time. And if we're working on non-client work, that's non-productive time. And to even define it a bit further, work that is productive is assigned a billable rate. It's a billable activity, where work that is non-productive, it could be considered productive because you're doing marketing or you're doing training or whatever it is. It could be considered productive time for the business, but if it's not accumulating work in progress, it's not accumulating billables, it's not productive time. So it's very important to understand that. So productivity is the ratio of billable time to total time worked. Okay, so to calculate productivity, we need to look at the billable hours, the non-billable hours, giving us the total hours, and then from there we can calculate productivity by dividing the billable over the total hours. Now, let's say this is a whole week. Over a whole week, let's say we did 30 hours of billable hours, we did 10 hours non-billable, giving us a total of 40 hours, and then it gives us productivity of 75%, because 75% of our time was spent on billable activities. Now in this example here, let's look at, this is the first day of the week, this is Monday. And for the day, we did 6 billable hours, we did 2 non-billable hours, giving us 8 hours total. Now we're going to introduce leave here because I want to show you how this impacts productivity. So leave, there's 0 hours. So all hours is 8 hours. We've done 8 hours in total, 75% productivity. So the same as that week example we looked at. Now let's say on Tuesday, we weren't quite as productive as we were on Monday. So we end up doing a total of 10 hours. So if we add our 6 to the 4 hours we've just done on Tuesday, we've got 10 billable hours. We've now got 6 non-billable hours, giving us total hours of 16. Still got no leave, so we've done 16 hours, So our productivity's dropped from 75% down to 62.5%. So we've had a drop in productivity because we've spent more time on non-billable activities. Now let's say on Wednesday, we take the day off. So we have 8 hours of leave that day. So we've still done 10 billable hours for the week, still done 6 non-billable hours for the week. So we've got a total of 16 worked hours. This is what we use to calculate productivity. It's that total hours. Now we've got 8 hours of leave. So in all hours is 24. There's 24 hours that have passed in the week, but only 16 of them were spent actually working. So our productivity doesn't change. And I wanted to show you this example to highlight that leave does not impact productivity. All that impacts productivity is billable hours and non-billable hours. So why is productivity important? Well, it is the quickest win you can get for your firm is setting some targets around productivity and getting your team to achieve those targets. Because our firm is essentially a machine of inputs and outputs. And we want to input time and we want to output the most billable hours as possible. Because if we're doing billable hours, we can bill, assumably, those hours, right? So if our productivity is low, it means that we are spending a lot of our time doing non-client activities, which is not generating revenue. So we ideally want to be doing more revenue generating activities compared to non-revenue generating activities. Now, what's really interesting is we've benchmarked firms across multiple countries, and we've done, I think, 5 years of benchmarking now. And across all the different countries we've done, productivity at average across all these countries swings between 54 and 56%, which means we are confident in saying that you should be aiming for 55% productivity at a firm level. So that includes your administrators, right? So if you have, say, 5 billable people and 2 administrators, you're going to find that it's quite hard to get your productivity up and over 55% because you're quite administrator heavy. So this is something to be aware of, is your ratio between administrators versus billable people. So not only do we want our billable people spending most of their time on billable activities, we also want to make sure we don't have too many administrators pulling the productivity of the firm down, because then you're still paying salaries for the administrators, but there's not that cash flow to then invest in hiring more people to create more capacity to bring on more clients. So if we get our ratio of administrators to billable people wrong, we find ourselves in a situation where we don't have the cash to create more capacity to bring on more clients. We find ourselves stuck. So that's where productivity is so important to look at. And you really want to avoid hiring administrators if your productivity is under 55%. Really, there's a little bit of wiggle room there, but I'd say if you're under 50% productivity, don't hire administrators. You need to focus on being more efficient with your team you already have. Get your productivity up before you start bringing on those administrators. So that's why our productivity is important. Now, how do we implement it in our firm? Well, we need to track this stuff in a practice management system. So we need to be timesheeting, and we need to be determining our timesheets being billable or non-billable or leave. We need to put them in one of these 3 buckets. So again, the billable timesheets accumulate work in progress, the non-billable don't accumulate work in progress, and the leave is excluded from our productivity calculations. So if we can get that, we then want to talk to our team members about setting some targets, some that are realistic. And then from there, we want to track our performance against what our targets are, and then we can look at moving our productivity ideally above that 55% mark. When we get there, the firm should be profitable, provided that you're not having high write-offs, and we could look at growing the firm by increasing our capacity and bringing on more clients. So that's productivity, that's why it's important, and that's how you implement it in your firm. Recoverability is where you gain the greatest insight into the operations of your firm. Recoverability can be defined as the percentage of work performed that converts into billable revenue after adjusting for write-ons and write-offs. Put more simply, it measures how effectively a firm turns effort into cash. Now, I've got some examples lined up here that we're going to take a look at, and there's 2 things we're focusing on. One is our write-ons and write-offs, and that's in the perspective of our WIP equation. So from our opening WIP through to our closing WIP, we're going to have write-ons and write-offs, or net write-ups as they're called. That's one part of recoverability. The other part is looking at recovered rates. And how we do that is we take that write-on and write-off information, and then we look at how many hours went into the work that caused that write-on and write-off, and then we can calculate our recovered rates. I've got some examples lined up where we're going to look at both of these, and then at the end we'll look at pulling it together and talk about why we want to do this and how to implement it in your firm. Cool, so we're familiar with the WIP equation, which is opening WIP, time added, disbursements added, invoiced, net write-ups, and closing WIP. So we just add all of those rows together. Invoices are negative because they reduce work in progress. So if we add them all together, we get our closing WIP, right? So this first job here, we've added $3,400 of time to it, and we've invoiced $3,000, so we've ended up with a write-off of $400. So that's low recoverability, right? We've written off some of that time. Whereas job 2 here, we've got $1,900 of time, we've invoiced $3,000, so there's a $1,100 write-up, so it had great recoverability. So that's looking at recoverability on a job basis, but we can also look at it on a team member basis. So we've got 2 team members here. We've got Kate and Ted. Now for a month, let's assume all things equal that the jobs were started at the start of the month and closed at the end of the month. So we've got no opening or closing WIP. Just want to keep these examples nice and easy. So let's say Kate in this month added $27,500 of time to these jobs. We invoiced $30,500, so there was a $3,000 write-up, so she had good recoverability this month. Whereas Ted did $26,300 of time and only invoiced $23,400, $2,900 write-off on his jobs. So looking at this information, we could say that Kate had a good month, Ted didn't have such a good month, so we should talk to Ted about lifting his performance. But we want to dive deeper into these numbers to see what's going on. And this is the real magic of recoverability comes into it here when we start diving into the numbers. So if we look at this next example, we've broken down where those numbers came from for Kate. So she had 8 jobs that she worked on, and then we can see here that we've got some that had write-ups and some that had write-offs. So you can see that she's got a job at the bottom there with a big write-up of $2,300, so in total $3,000. So a pretty good pattern here from Kate, so we're pretty happy with her performance. Now if we look at Ted, we've got a very different story that's being told here. Ted actually got write-ups on all of his jobs except one. This job at the bottom here, he put $6,400 of time to, but we only invoiced $1,500. Now the reason for that was because the partner underpriced the job. He didn't anticipate how big it was, he didn't ask enough questions, underpriced the job. So Ted ended up having to write off so much time on this job, which would have affected his capacity, would have affected his ability to deliver other jobs, would have affected so much. But overall, he's had to write off $4,900 of time. So if we were to just look at Ted at a monthly basis and say, hey Ted, you wrote off almost $3,000, you had a bad month. Ted's actually had a great month, but there was a job that was underpriced. So that's why it's really important to dive a little bit deeper into the numbers to see what's going on. And again, this is the magic of recoverability, is there's so much information here. So if you see write-offs, it's a really good reason to have a good conversation. It's not a reason to come down on someone. You need to investigate why they're happening so we can fix the problems. So this is looking at recoverability using the work in progress formula. But what we can do is we can elaborate on that. We can start bringing time into the equation. And what that does, it starts allowing us to calculate more things, such as recovered rates. Next example here, what we're going to do is we're going to remove parts of the WIP formula and we're going to bring in some time data and see what we can calculate from here. So we've got the WIP formula, but we're not interested in opening WIP, disbursements, invoiced, and closing WIP. So let's get rid of those. And instead, we want to include recoverability, revenue, hours, and recovered rates. And I'll explain what each of these are. So recoverability is the same as your write-up percentage. So it's basically the percentage of time that we've written up or written off on these jobs. Now revenue is calculated by taking the time within the period and adjusting by the net write-ups in the period. So it's not the same as invoice. And the reason for that is because invoices don't always fall on the same period in which we do the work. So if we have a client invoice for $10,000 one month and there's no time in that month, how do we attribute that revenue to the time? We can't. So instead what we do is we take the billable work done and we adjust by the net write-ups and write-offs recognized within that period. And that's how we calculate our revenue. So it's very important we understand that. So that's how revenue is calculated. Then we just look at the hours, the number of hours required to arrive at that time. And then from there, we can arrive at our recovered rates. So let's pull some figures into this. So let's say Ted's billable rate was $200 per hour, and that's how we arrived at all of those time values. We've got our net write-ups, which were pulled straight from that WIP report, but now we can calculate our recoverability, which we could also call our net write-up percentage. We can see here that he's had pretty much write-ups on all of those jobs, except 76.56% written off on that last job there. So then we can calculate our revenue, and then in this example here, the revenue does match the invoice because I've tried to keep the example nice and simple. But if we do have WIP flowing in and out of different periods, that's where revenue is the only way to calculate these rates. So then we've got the hours. The hours were the number of hours used to generate that time. So if we look at the first job, Ted's billable rate is $200 an hour. So 10 hours gave us $2,000 of time. Pretty straightforward, right? So that's $10 higher than Ted's billable rate. And that's represented by that 5% recoverability. See how these things are starting to tie together now? And if we look at this last job, we only charge $46.88 an hour for the job. And that's where we can start analyzing this data to understand at a team member level or at a client level or at a service level, what rate are we actually charging for this work? The reason that recovered rates are really powerful and not just looking at the recoverability percentage and also the write-offs is because write-offs are indicative of billable rates. So in this next example here, what I've done is I've lifted Ted's billable rate from $200 up to $600 per hour. So we've tripled that rate, which means the WIP created or the time added in the formula or in this equation is going to be triple. And then what's going to happen is we invoice the same amount because Ted's created the same amount of value to the market, right? He hasn't done more, he hasn't created more value because we put his rate up. It just means we've put his billable rate up, and that comes through in his write-offs. So let's take a look at this. So now Ted's rate is 3 times higher. So all this time added is going to be 3 times higher than the previous example. So now we've got huge net write-offs. Our recoverability is at negative 70%. So we're writing off 70% of his time. The revenue hasn't changed because that's the what we're able to bill. So if we were to take the time added, adjust by the net write-ups, we arrive at the same revenue figure. So that hasn't changed. The number of hours hasn't changed. Therefore, our recovered rates have not changed. And again, that is the magic of using recovered rates, as it cuts through all the noise of having recoverability percentages and our write-ups and write-offs. So why is recoverability important? So the first thing is the recoverability looks at how effective our team members are. So if we're just interested in productivity, that's a bit of a trap, because what we could say is we could have a junior who spends 8 hours of his day, full 8 hours, 100% productive, looks great, but he spends 8 hours doing a task that should have taken 1 hour. So although he was 100% productive, his recoverability was awful because we would have written all of his time off to arrive at maybe $20 or $15 an hour. So that's where we need to look at both recoverability and our productivity to get an understanding of what's going on. So we can't just look at productivity alone. Recovered rates cut through all the noise, so that's why we don't want to just look at what our write-offs are and what our write-off percentages or our recoverability percentages. We also want to look at those recovered rates because that's going to cut through the noise of what our billable rates are. So recoverability allows us to determine how effective our team members are at doing their work, which helps inform decisions such as pay rises. So if we've got 2 team members and we look over an entire year for all the work they've done, all things equal, and one's at a recovered rate of $250 an hour and the other one's at a recovered rate of $150 an hour, we could say, well, this person on $250 an hour should probably be on a higher salary because they're delivering more value and generating more revenue for the firm. So that's looking at it from a team member perspective, but from a client perspective, if we look at our entire client list in one report over 12 months, we can look at all of their recovered rates and we'll find out one side, if we were to sort from high to low, at the top of the report, we're going to have really high value clients, $800, $900 per hour and a whole lot of work done for them. Or at the bottom of the list, we might find clients we've done 50, 60, 70 hours for at $10 an hour, $15 an hour. So what we can learn from this is we can look at the top of the list and go, what are we doing well for these clients? Who's working on these clients? What services are we delivering? Why have we priced them this way? Then look at the bottom of the list and go, right, we need to lift these clients' fees to come up to the middle of the pack. So that insight really helps you look at your client base and determine whose fees need to be lifted and which clients we could learn from. So how do we implement this in our firm? So the first thing is we need to use a practice management system that's going to track time, invoice, and give the ability to analyze your write-ons and write-offs and calculate our recovered rates for us. Now then, what we want to be doing is we want to be focusing on reporting on our people, our clients, and our services. So conveniently, it's PPP. So first is our people. So we want to be analyzing our recoverability and our rates per person. The next thing is our pricing. So the clients is our pricing. So we want to look at all of our clients and how we've priced those services and what rates we've arrived at. And that's the next step. And the last one is to look at our process, which is looking at our services. So if we look at all of our services and what rates across the whole firm we're achieving for each service. So if we can get our people working effectively, and we can get our clients priced effectively, and we can deliver our services effectively, we're going to make a lot more money in our firm. Pricing is something that's often overlooked in a firm's strategy. So in the context of this conversation, I'm defining pricing as the method in which we charge for our services. So there are 3 methods in which we can charge for our services in a firm. So there is time and cost, there's quoted, and subscription. Now there's a number of variations we can have, within each of those three categories, but there is only three ways we can charge for our services. So there's time and cost. So time and cost is when we're billing on an hourly rate. So we define an hourly rate and then we charge for our services based on the hours we do based on that rate. Now this may include a deposit, right? So there is, as I say, variations within each of these, but you could include a deposit, but then there's the hourly rate that kicks in. But the key here is it's done on hours and there's no agreed fee. Now, as soon as there's an agreed fee, you enter the next type of pricing, which is quoted. So as soon as you provide a fixed fee, that becomes a quoted engagement. So that could include a deposit, it could include a progress payment, and it would include a final invoice. But the idea is there's an agreed fee on those services. Now, the last method is subscription. Now, this is also an agreed fee, but the difference is it's billed on a recurring basis, usually monthly, sometimes quarterly or sometimes weekly, but in general, it's done on a monthly basis. Now, what I've done is I put a matrix together to look at the pros and cons of each of these billing methods. So we'll look at that now. All right, so let's look at time and cost first. Now, the pros of time and cost is easy to sell. It's really easy to say, hey, I'm going to do this work for you, $100 an hour, and let's just get things started. So it's easy to sell. And the other benefit is it's easy to track. Just any system, you could use a spreadsheet, you could use some sort of time tracking app. You can just track very easily the number of hours you've done, you multiply it by your rate, and then you send an invoice. So it's very, very simple from an administrative perspective and tracking perspective, right? Now, the downsides of time and cost is there's a high risk of client churn. Now, let's say, for example, I'm going to do some accounting services for you. I'm going to do a tax return, and then there's no conversation about budget, right? Because this is time and cost. And I say I'm $100 an hour, and you might think, cool, might be about 4 or 5 hours is sort of what you're expecting. I go and do the work, it's 12 hours, and I send you an invoice for $1,200. You're going to balk at that, right? And then you're probably going to either argue the bill or you're just going to pay it and never work with me again because your expectation was $500 and I charge more than twice that. So there's a high risk of client churn with time and cost engagements. And that can also relate to, you might have an agreed fee for part of your engagement. So it might be a tax returns this, but the advice is done on an ad hoc basis. It's those ad hoc unpriced engagements where you can really damage client relationships. So it's a good idea to try get an agreed fee in place for any type of engagement. Now, the other con of time and cost is there's no opportunity to increase your margin. So if I'm saying that my rate's $100 an hour, the most I can ever bill is $100 per hour, right? So worst case scenario is you argue the bill and I have to write some of my time off, but I'm never going to go above $100 an hour. So that's time and cost. Now, quoted. Now, the benefit of quote is you have happier clients. And the reason you have happier clients is because you state the price and you state what you're going to deliver for that. You deliver that and you charge your price. So the communication is clear the whole way through. There's no surprises. So you end up having happier clients, which are less likely to churn. The other benefit of quoted is higher margins. So let's say, for example, you're going to get a tax return done by me. And I say that, look, it's going to be $2,000. And then you go on the high side, but cool, happy, $2,000, let's do it. I've communicated it's going to be $2,000. I'm going to deliver by this date. I deliver by that date. I send an invoice of $2,000. Everyone's happy. But I may have only put 12 hours at my $100 rate on the job. So I end up making an $800 write-up. So I've increased my margin and I've increased my recovered rate on that job. So there is that opportunity to increase your margin when you are quoting jobs. Now, on the con, of course, there's the other side of the coin. You need to be more confident when pricing, because if you go and agree on a job and say it's $2,000, you end up putting $6,000 to that job, you've got a problem. There's a large write-off there. So there is that confidence required when pricing. You need to know how to price your jobs, and you also need to be confident in selling as well, because if you're out there, you might end up underpricing your services because you're not confident in sales, where it's easy to just go, oh, my rate's $100 an hour, my rate's $200 an hour. That's an easier conversation to have for someone who's not good at sales compared to saying, hey, I'm going to charge you $2,000 or $3,000 for this job. So that's where confidence in sales comes into it, and confidence in pricing jobs correctly. And then the last con, obviously, there's a higher risk of write-offs, which we sort of touched on earlier. So if a job can go well, you can have a write-up, you can also have a write-off on those jobs. So that's the quoted pros and cons. Now, subscription. Subscription is a method that's been adopted quite widely over the past sort of 10 to 15 years, probably 10 years. It's been quite widely adopted in the accounting industry, and it has had. There's been a bit of a swing back to people not adopting it, and it's probably because some of the cons I'm about to talk about are the reason for that. But the benefit of subscription is, and I suppose just touch on that, it's sort of following the SaaS business model, right? And like Netflix, and there's a lot of subscription business out right now. So a lot of firms are jumping on by having subscriptions for their clients. So the pro, it's better for cash flow, right? So it's better for the cash flow for the firm because you can very accurately predict what your cash flow is going to be. It's not lumpy based on filed returns or the work being delivered. You can accurately forecast your revenue, and then what it does, it also allows you to very accurately know when you can bring on new team members to increase your capacity, right? So if you know that your subscriptions cover your wages and your subscriptions increase, you can confidently hire that next person, knowing that you can cover them based on your base subscription fee. And any extra capacity for each team member, that becomes potentially billable, chargeable work, which becomes just extra profit for the firm. So that's the big benefit there for the firm of the cash flow. And from the client's perspective, it's a lot more beneficial as well, because rather than getting an accounting fee of, let's say, $1,200 out of nowhere, they get to spread that over $100 payments throughout the month. So $100 going out each month, not a big deal, but having to come up with $1,200 potentially for some clients, it's a bit of money, right? So it's easier to just pay $100 a month, just knowing your accounting's looked after. So there's a huge cash flow advantage there. Now, the next one is it's easier to bundle other services. Now, typically when you're quoting one-off jobs, you're quoting like a tax return or some sort of filing or whatever. Now, with these subscription services, it's easy to go, hey, well, we're doing your tax return, but why don't we catch up every quarter and we can review your, let's just say it's a business that manufactures soda, they're a boutique soda manufacturer, right? So you have an perpetual inventory system, so you can get some really good information out of this inventory system, and you can sit down with that client every quarter, run through the numbers, look at their margins on products, look at their customer base, and come up with a strategy about how they're going to grow their business. So you can move from purely just doing tax returns very easily into becoming a trusted advisor and starting to do some business coaching based on management accounting numbers. And it's easier to, rather than say, oh, I'll charge you $6,000 for that service, you can just bundle it into your accounting fee, go, cool, well, your accounting fee is going to be $200 per month, and it's going to be $500 a month for this coaching service. So there's a subscription of $700 a month going out. But what they're getting is they're getting this amazing service of not only their taxes are looked after, but they've got a quarterly coaching, they've got accountability in place. So your opportunity to increase your margin through bundled services is huge. Now, the cons, much higher admin cost. So managing subscriptions is a lot of administration, because what we need to be doing to accurately calculate our work in progress is we need to have the revenue for those invoices mapped to the job in which the time is also added. And that's for WIP wash-up purposes. We can't have the revenue not exist on the jobs, and we can't have the time on one job and the revenue on another job. We have to have the time and the revenue on the same job, which means we need to be have a system that marries up the time and the invoices, and we also need to have a process around doing WIP wash-ups once a year so we can recognize those write-ons and write-offs, and also being able to report on that. So there's a lot of administration that goes with this. And to date, there hasn't been really any good systems to manage that effectively. So there is a higher administration cost of running these subscriptions. There's also a higher delivery risk. And by delivery risk, I don't just mean margins, so you might go over budget, but there's also, if you've got all of your clients on a subscription basis and you've committed to filing their taxes by their deadlines, you might run into the situation where you've collected all these funds and you don't have enough capacity to get all the work done. So there is that risk of non-delivery after collecting the funds, where if it's unquoted, it's still bad if you're going to miss due days, right? So it's still bad. But if you've collected the money as well and you miss it, it's just double bad. So that's the other con. But it's that balance. It's like for subscriptions, there's a huge benefits there. It's massive, but there's also quite significant cons. So yeah, those are the three pricing methods. I would steer away from time and cost due to the risks around client churn and lack of comms around deliverables and pricing. Quoted's a great one, subscription's a great one. It's just whether you want to take that leap into doing subscription and dealing with the administration cost. So how do we implement this in a firm? So what you want to do is you want to have a strategy. So you want to talk to, if you do have business partners or other partners in the firm, you want to sit down and go, cool, what is our strategy for pricing new clients that come in the door? So if you are going to move into the subscription world, you want to have an understanding about what are you going to charge, what does the back office look like, how are we going to deal with the subscriptions, how are we going to marry up the invoices to our timesheets. All these things need to be planned out. And then you could look at rolling that out and making sure their engagements are set up and there's an understanding. So do a big plan around how we're going to roll out this type of billing. And then you go out and actually just start pricing it. You start pricing some jobs, they start coming through, and then we want to then be reviewing our pricing. So that's where it's really important to look at our recoverability at a client level, because when you do walk into these quoted and our subscription type engagements, it's important to understand what our recoverability on those, because if we're not tracking recoverability, we could be writing off huge amounts of time. And so one more point to mention on the subscription billing method is that there's 3 methods of subscriptions within subscriptions. So we have in advanced, we have in period, and we have contract period. In advance essentially means that the subscription is paid, so they pay all 12 installments, monthly installments, before we do the work, right? So that means that you have a tax year and then you do the filing the following year. So we collect all the funds up front in one year and then we then do the work the next year. And the in period method, what we're doing is we are charging in the period in which we do the work. So you might end up having 4 months of charges, we do the work and they pay it off over the following months of the year. So there's the in period method. Then there's the contract period. The contract period is the date that they came into the firm to sign up as a client. That's the renewal date and we just roll them over. So typically we advise against the contract period method. The reason for that is the administration just absolutely blooms. It's enough administration as it is managing subscriptions, but if you're having to manage the rollovers every single month, it becomes a nightmare. So you want to have a 1 month of the year, generally align it with your firm's financial year as your renewal date for all of your subscription contracts. Then you want to understand, do you want to go for the in period or the in advance method? The benefit of the in period method is a lot easier to sell because they're not paying in advance. But the downside is that you might end up delivering the work, and where in a quoted method you could have gone and billed that the rest of that work straight away, they are paying it off over those later months. Whereas with the in advance method, you're collecting all the funds up front, which is amazing for cash flow. And I've seen a number of firms who run an entire fee base, like $2, $3, $4 million of fees. They run all in advance. So that means that their bank account is literally sitting with $3, $4 million of cash in it without even doing any work, which is fantastic for cash flow and growth and being able to hire and all those sorts of things. But there is that risk there of not delivering the work, of course, because you've been paid in advance. And more so, it comes down to the partner's ability to sell. If you're not confident in selling, this is not a good method. So the firms that I've seen be successful at unadvanced subscription methods are ones that have got fantastic salespeople in selling to clients, because they can communicate with the client, you pay up front, we'll do the work, and that's how we engage with you. So those are the 3 methods: time and cost, quoted, and subscription. Make a plan with your team. Get all the infrastructure set up if you're going to move to the subscription method. Just weigh up those pros and cons, and go forth, go well. Capacity is the most powerful metric to grow a firm. It's the production plan for your machine. Work in progress, productivity, and recoverability all look back at historical information so we can make better decisions going forward. But it's looking backwards. Capacity looks forwards. It's how we predict the future. We can define capacity as the total hours available for client work after accounting for leave and making allowances for internal time. So we're going to look at some examples here. The first is going to be a static capacity plan for an entire year. So this is a very basic introduction to the concept of capacity. Then we're going to go a step deeper and look at the capacity for an individual team member. And then we're going to look at taking that individual team member's plan and making it live with inputs. Let's hop in and check it out. So this is a basic capacity plan for a whole year, and anyone can do this. You can do this now with the information you already have available. So you have the hours per week each team member works, then the hours per year just by taking the hours per week and then multiplying by the number of weeks we expect them to be working. So I've used the number of 45 here, accounting for the leave that each team member will be taking. Then we have our target capacity. This is a very important number to capture. Now, target capacity is what we expect them to be working on as a percentage in terms of client work to internal work. We then have our billable rates, which is the rate that we charge by hour. Then we have our target billable hours, and we're doing that just by taking the hours per year multiplied by their target capacity. We then have our expected non-billable hours, which is just the inverse of that. And then our target productivity, you'll notice, is exactly what their target capacity is. So capacity is looking forward, productivity is looking backwards. So if we plan to be 75% as our capacity, if our plan falls into place the way we plan, our productivity would also be 75%. So productivity and capacity are intertwined. Then we have our target revenue, and our target revenue can be calculated by taking the billable rate and multiplying by the target billable hours. And from here, we should be able to calculate at a firm level what fee base we should be able to look after if everyone is as productive as we plan in their capacity. So in this firm here, we see they could take on almost $1.2 million. What's interesting here is if we look at this firm, we're only aiming at 50.77% productivity, and the reason for that is we've got 2 administrators and only 5 billable team members. And this is a situation that comes up all the time where we hire too many administrators, so our productivity, we find it very hard to lift above that 55%. So that's a basic capacity plan, and this plan is great under the following assumptions. You have no staff leave, you hire no new staff, everyone hits their exact productivity target every month, no jobs take longer than expected, no jobs are completed faster than expected, no new work comes in, no clients leave our firm, and everyone takes exactly the right amount of leave every year. And I could go on. Basically, this is a static plan, which is a bit of a rule of thumb. What sort of fee base can we look after? But by no means is this something that's going to help you grow your firm. What we want to be doing is we want to have capacity that's live and always informing our decision making. So capacity is the natural byproduct of your workflow. Your workflow system must measure and track capacity in real time. Now, to keep our capacity plan live, we not only need to plan how much capacity we expect each person to be working at in terms of that percentage, we also need to allocate the work to our team members. So each team member needs to be allocated a job with an estimated number of hours and a due date, and that informs our capacity plan. This is how we calculate monthly individual capacity. So we first start with the hours per week the team member works, and then from there we can work out the hours they work per day. So we've got 40 and then 8 hours per day. Now each month is going to have a different number of work days within the month. So let's say this month here I've got 21 work days in the month. So that means there's 168 hours available in this month. We then need to subtract any leave taken. So let's say this team member's already logged 8 hours of leave. So that gives us available hours of 160. Now we've set their target capacity to be 75%, which means 75% of the time they're working on client work, which is billable, allowing 25% of their time for any internal activities. So we want to allocate work to our team to build our capacity plan. So this is what their split would look like right now. So every team member has 3 buckets. They have allocated internal time, they have allocated billable work, and they have available capacity. So at the start of the month, this team member would have 40 hours of allocated internal time and available capacity of 120 hours. So we then want to allocate work to this team member. So let's say we allocate them a 10-hour task. We'd then see their available capacity reduced to 110, and they now have 10 hours of allocated billable work. And you'll notice they still have 160 hours remaining in this month. Now, we want to go through and allocate as much work as appropriate to our team members. So we want to keep an allowance of available capacity for things that come up. So potentially tasks that take longer than expected, or if a job comes up that we weren't expected, or also provide the opportunity to take on some higher value coaching or consulting work there as well. So we don't want to allocate 120 hours to a team member. We'd want to allow some buffer in that. So this is a really nice balance here where we've got 40 hours allocated for internal time, 100 hours of work allocated that needs to be done this month, and 20 hours of available capacity, giving us that 160 hours. Now, how do we keep capacity live? So capacity is kept live by using a system, right? And the system is your workflow system that also has capacity as part of it. So capacity should be updated with every new allocation. So every time a new task or job's allocated to a team member, it would update their capacity. Every reallocation, so if we take a job off one person and give it to the other person, it should update both people's capacity. If we change the month that something's due, that would update the capacity for both months. Completed tasks also affect capacity. So if we have a task that was allocated 10 hours and we do it in 6 hours, there's 4 hours that we had in our plan that we no longer need to do, so that would open up 4 hours of capacity for that team member. Now, every timesheet also impacts capacity. So there are 4 types of timesheets we can do. So let's just start at our starting point. So this is the start of our month, right? So we have our 40, our 100, and our 20, giving us 160 hours for the month. Now let's say after the first day of the month, we've done 8 hours of work. So if we did 8 hours all to an internal task, what we'd see here is our allocated internal time, our allowance would go from 40 down to 32 because we've used up 8 of those hours. And that arrives at 152 hours, which is the remaining number of hours we have in the month. We could also do 8 hours to an allocated billable task. In that case, we'd go from 100 down to 92 for our billable. And again, our remaining hours would be 152 for the month. We can also add 8 hours to a billable task, but a billable task that's not allocated to us. So it is productive time, it's not internal, but it's a task that isn't in our plan, so it can't come from that 100 hours, because if we've planned that 100 hours, therefore that's going to reduce our available capacity by 8 hours, so we'll be done at 12 hours, giving us 152 remaining hours. And there's also the situation where we add a leave entry. So if we add leave, so here we'd see our allocated internal drop from 40 down to 38, and our available capacity would drop from 20 down to 14. So that's been split between our capacity percentage. So 75% of the time was reduced off our available, and 25% of the time was reduced off our allocation for non-billable. So why is this important to track? So by tracking capacity, we're able to see how much available capacity each team member has at any time live. And there's so many benefits to this. So one of them is you're in the business of buying and selling capacity. So capacity is the inventory of your business. Now, every business has capacity. So a restaurant will have tables, an airplane or an airline would have airplane seats, right? So every business has capacity, and your capacity is the hours that you're purchasing from your team members, and then you're on-selling those hours at a margin. So you really need to be tracking that. It'd be like a manufacturer not tracking their inventory, or a restaurant not tracking the tables or their table turn, or an airplane not having a booking system to book those seats. You need to be tracking your capacity. It also allows you to balance your workload so you don't overwhelm your team. So without visibility into how much work everyone has, you overload some people and others get a free ride, and generally end up overloading our best people. So this is the next one here, is you keep your best people, as work generally gravitates towards our best people. We end up overloading them. Those are the ones that get stressed, they don't complain, and eventually they leave, and you end up having to then replace them, which is a hugely costly expense. You can also see, because you can see your available capacity, you can see how many more clients you can bring on board comfortably. A big problem that can happen is if you don't know what your capacity is, you'll just keep bringing more and more and more clients on and giving all this work to your team. There's no capacity for it, so everyone gets stressed, and what happens? They leave. So that's another big problem. Knowing what your capacity is means you can forecast how many clients you can bring on before you need to hire again, which is the next one here. You know when to hire. So once you run out of capacity, provided you have hired your team correctly and you have good recoverability, you should be able to then hire to create more capacity to bring on new clients. That's the cycle of a firm. You fill your capacity, you have margin, you hire to create more capacity, and you fill those. That's the process of growing a firm. So you can see why capacity is such an important part of this solution here. Another one is you can deliver what you say you will, because you are accurately able to plan your work, and you know that everyone is able to get their work done because you haven't overloaded everyone. You're confident in what you can deliver, so if you make a commitment to a client, you'll be able to deliver on that commitment. Now with that extra capacity that you have, you're able to upsell advisory services, which is higher margin. So you might have a month where you complete all of your planned jobs a bit quicker. There's 20, 30 hours at the end of the month. We can either work on some jobs for next month, bring those forward, which again delights your clients, or we can look at upselling some advisory services to our clients as a higher margin, which increases our recovered rates. So being able to upsell advisory services. Now, you want to maximize your revenue with the capacity you have. So if you have a restaurant that has 20 tables and a restaurant that has 5 tables, everything else equal, restaurant with 20 tables should make 4 times as much money as the restaurant with 5 tables, provided they are filling their capacity. But if they are not focused on filling capacity, the restaurant with 5 tables and they're focused on filling capacity could end up making more money than the 20 staff restaurant, because they're having to pay for all that space for all those, so not 20 staff, 20 table restaurant. they're having to pay for all that space. So by optimizing your capacity, you're able to make sure that you're maximizing the revenue with the capacity that you have. You can make micro adjustments to your plan. So as things change, you're able to change tact very quickly. If you just do that single plan at the start of the year, it'll all fall apart within a few weeks when things move. But you're able to make micro adjustments all the way through if you're keeping up with live capacity. You allow your managers to manage. So at the moment, without capacity, if your managers are trying to manage the team, they're relying on vibes and conversations with people, but they have no idea how much work each person is allocated. They can look at a job list, but they don't know how many hours is remaining on each job. So by having actual data to back up these conversations, it makes the manager's job so much easier managing their team, so their team are better informed, and the whole thing just operates better. Job turnaround improves. This is another big one. So job turnaround is how quickly we can push a job through from open to close. A big problem that happens when capacity isn't managed properly is we just keep starting all these new jobs. We don't have all the information required to finish them, so we just keep opening more and more jobs up. Next thing you know, you're playing keepy-uppy, which is just hitting balloons up in the air with 50 balloons, and you're not getting anywhere. All you're trying to do is just keep these balloons in the air. But if we are able to have a really clear capacity plan and know what we're working on, we're then able to prioritize our work and focus on getting jobs done rather than just opening more jobs up and just playing keepy-uppy all day. Capacity is your production plan. So do you think Toyota has a production plan to build their vehicles, or do they just jump on whatever car when the parts come in? They have a production plan, right? So, and that's because they are a successful business that produces high quality goods at an affordable price. Your business is a machine. It is inputs and outputs. You are selling capacity. You're not just jumping on whatever job comes in that day. Now, the last one is you're more likely to achieve your goals with a plan. So if you're going to run a marathon and you want to run a marathon in under 4 hours, you're more likely to achieve that if you have some sort of training plan and also a race plan. If you don't have any training plan, you just turn up on the day with no food or nutrition or no plan, you're less likely to hit that goal compared to if you had a plan. So by planning out what your year looks like in terms of your firm's capacity, you can watch that plan unfold as the year ticks by and make micro adjustments as you go. And it's also got the added benefit of everything else we talked about: happier team, we're turning through jobs faster, cash flow's better, everyone's happier. So as you can see, the most powerful thing you can do is track and manage and optimize your capacity in your firm. So those are the 5 steps to grow your firm that I can guarantee you won't get stuck if you follow them. So that is to manage your work in progress, increase your productivity, improve your recoverability, nail down your pricing, and finally optimize your capacity. Now, if you found this video useful and you'd like to see more of these, you can subscribe to our YouTube channel, as we are going to be pushing out a lot of content around this. We've only really just scratch the surface of a lot of these concepts, and there's so much more. Think of it as the tip of the iceberg. There's 90% is still below, and I want to explain all of that. So head along and subscribe to the YouTube channel, and leave me a comment under this video of the part that you found most useful. And if you do have any questions, drop that in the comments as well. My team and I do read all the comments. That helps us create more practical and useful content for you. So thanks for hanging out, and I will see you in the next one.